Really, Cranes Detroit? Really? Sensationalist garbage. And you used one of my listings with my face on the sign for that headline, calling Metro Detroit the most overpriced real estate out there. Way to do me dirty, Cranes. Way to do me dirty. And you, Yahoo Finance, shaking my fist at you. Let's look at this. Okay, so Grant Cardone is saying this is gonna be the biggest real estate correction in his lifetime. Did he forget about 2008-9? Was that too long ago? We saw 30 to 50% home values crash then. Is that what you're saying is gonna happen in 2025, Grant Cardone? Come on. Now let's go with facts over feeling walking into 2025. And it's time for our 2025 predictions. What's gonna happen? 2024 was definitely a wild ride, but we're through it, and now it's time to take a minute to see what's going on nationally and locally. Watch now to get out in front of the real estate markets, the finance markets, the crypto markets, the stock market, interest rates, inflation. We're gonna go deep and we're gonna cover it all. So I study this stuff on a daily basis and wanna be sure you're out in front of it to make the best choices for you and your family in 2025. And who am I? Who am I to be talking about all this stuff? So I am a local real estate agent serving families here in Metro Detroit. Reach out when you're ready to start the process of buying or selling your next home, and also scope out our over 3,000 reviews on Google and Zillow, and you could book a time on my calendar to talk directly with me, or just shoot me a call at the number on the screen. I've got your back. All right, so this is my 4th predictions video, and so far with my first 3 videos, my track record is a little bit over 80% nailed it. Out of 33 predictions over the last 3 years, I've nailed 27 of them. So again, that puts me over 80% on point. And how that breaks down is 80% was right, 5% was a push, wasn't right, wasn't wrong, but just didn't quite nail it, and 15% I was dead wrong. And then every year, I actually review those predictions, see what I got right and see what I didn't. And I just put that video in for 2024 predictions. Looking at the big dogs that are supposed to get this stuff right, like Goldman Sachs or Schwab or JP Morgan Chase, who are again supposed to be on the forefront of the finance sector, as well as players in the real estate industry like the National Association of Realtors, Zillow, and Redfin. These guys combined generally get between 35 and 50% of this stuff right through the years. This is why I take a lot of pride in my predictions, because I literally over double their correct percentages. So subscribe to the channel. We do drop new videos each and every week, and then comment. I want to see your comments, guys. Anything you agree with and you're like, Mike, you're spot on. Anything you think I'm dead wrong on, or you just want to roast me because you're like, man, this guy, he's kind of full of it. Go ahead and put that in there too. All right, so let's jump in. 2024 was a roller coaster for the markets, for real estate, and for stocks. So here we are in 2025, a real land of uncertainty. So let's add a little certainty to it. So first up, real estate. I mean, of course, real estate. That's kind of what I eat, drink, and breathe daily, right? Now, before we get to 2025, we've of course got to take a look back at 2024 now that the numbers are out and we've got the number of nationwide sales, which actually dropped from the 2021 peak where we had 6.8 million home sales, a record in the United States, all the way to 2023 where we only had 4 million home sales. And then in 2024, we did tick back up to 4.62 million home sales nationally. So nationally, demand has actually fallen dramatically year over year nationwide to just start moving forward again in 2024. And we're seeing the same here locally in Metro Detroit. So most economists predicted the 2024 market to be completely flat or even decline in values nationally and here locally in Metro Detroit. And in 2024, some metros actually did start declining in value, but that clearly did not happen here in Metro Detroit. In fact, Zillow has us up nationally as far as home values go overall 2.5%. And locally here in Metro Detroit, we beat the market and we're up between 4.4 and 5.8% depending on what area you're in. And of course, the high point, kind of dragging us all up, is Corktown, which is up 24% in 2023 and another 8.5% in 2024. That has been heavily influenced by the $1 billion Central Station overhaul, which is gorgeous, by the way. If you haven't been, go see it. It's a wonder. It's beautiful. And that caused a ton of articles like these to come out this year. But what's next? With high interest rates, persnickety inflation, slowing job reports, where does that leave housing? If you're a buyer and you're waiting until 2025 for a market crash, guys, that's not gonna happen. plain and simple. I'd rather be direct and upfront with you and just tell you that straight out. Also, if you're a homeowner and you're hoping that prices are gonna shoot through the roof, go to the moon as they say, like they did in 2020 and 2021, and you're going to pick up a ton of equity, well, that's not gonna happen either. It's just not. So we're coming out of the second lowest number of home sales since 2010. 2023, we saw 4.09 million home sales. 2024, 4.62 million home sales. So those were hard years, just coming out of the pandemic. So let's go back even further. The next lowest number of home sales was way back in 1995. Okay, so let's look at the first number of home sales in 2025, then we'll look at home value predictions in 2025. So the experts' great guesses for 2025 are way wider in range than in almost any other year since I've been looking at this data. So the low end is 4.1 million home sales, that's a guess, and the high end is at 5.7 million home sales. So Redfin started us out at the bottom, down at 4.1 million home sales. Fannie Mae is way up at 5.2 million home sales, right there with the Mortgage Bankers Association. Goldman Sachs has us at 4.95 million home sales. Zillow believes we're gonna have 5.5 million home sales, and the outlier is the National Association of Realtors. Their own economist, Yoon, has us at 5.7 million home sales in 2025. So with all that said, it's pretty clear no one has any clue what's going to happen with the real estate market in 2025. However, I do. Home sales nationally in 2025, my prediction is going to end at 5.3 million home sales. And I'm putting my stamp on that. As rates come down, builder starts keep going up, and rents keep pushing people from becoming renters going into being buyers, sales are going to rise. The major holdback from the 5.7 million, the boomers. So just that one 18-year generation has literally 50% of the nation's equity, $17 trillion. Also, 54% of that generation has their homes completely paid off, and the rest of them are averaging 60% equity. Yeah, they ain't moving. Literally anything they do will be more expensive. And because they've been in their home for an average of 24 years, in Michigan and in several other states, they pay significantly less property tax than everybody else. At the end of this video, I'm actually gonna go through an example here locally of a boomer that's been in their home for 24 years, names and addresses, of course, omitted. I don't wanna put anybody on blast. I don't want anybody showing up with like pickaxes or anything saying, you need to pay more tax. I don't need any of that stuff happening. I don't want any bad press. So we're gonna omit all that. Okay, but what about prices? We talked about how much they have raised, but what about 2025? Okay, let's go to the major experts first. First, oh, good Lord, Money Magazine. Talk about a clickbait headline. Has it really come to this? Has it really come to this money? And then straight out the gate, they talk about how much home prices are rising, not going down. And that's why it's important, my people, to ignore headlines. Starting at the bottom, Freddie Mac has home prices going up just 0.6%. So basically nothing. The National Association of Realtors is at 1.9%. Okay. Realtor.com is coming in hot at 3.7% as far as home values going up, but the high one on this graph is Goldman Sachs touting 4% home value appreciation. Now, in previous years, they also have been the lowest, and they might have decided this year, we're just tired of being wrong. Goldman is tired of being wrong, so we're just gonna be the highest. Okay, now where am I at? And I have been dead right on this one 3 years running. Nationally, I see home values going up 3.8%. So with homes on the market finally going up, and investors pulling back a little bit in the second half of 2024, I think that's about spot on. For Metro Detroit, that's the tricky one. Detroit and Michigan's population are both up for the first time in a long time, and I'm talking decades. We're gonna get more as though the Y on the wage section. So every economist from U of M to nationally has Metro Detroit rising a steady 1.3 to 2.1%. But I'm gonna be very bullish on Metro Detroit. I'm gonna peg it at 5.1%. But is it that crazy? I think we might even see higher than that in some places like Grand Rapids or Greenville, South Carolina, or New Braunfels, Texas, and a few other areas. So no, I don't think 5.1% for Metro Detroit and Michigan is a pie in the sky number at all. So I'm hanging my hat on that one. All right, before we get to interest rates, if you haven't subscribed to the channel, do so right now. We drop new videos each and every week on all things Metro Detroit and real estate, including what's fun to do for adults and kids every single month. Interest rates. Okay, if there was a talk of the town or a belle of the ball in 2024, interest rates were it, and that talk is gonna keep on keeping on right through 2025. 2023 may have been the year where the talk was all about inflation, but 2024 and 2025, it's all interest rates. Now, the Fed has committed to lowering rates a measly 2 times in 2025. So what does this mean? We've seen 11 rate hikes from March of 2022 to now, pushing mortgages and credit cards and car payments and car loans to their highest levels in 22 years. That was actually the year I got my first mortgage, and my interest rate at that time was 8%. And we actually hit 8% a couple of times in 2023 and 2024, as I predicted. And then rates started coming down, as I predicted. So there are three scenarios that can play out in 2025. We could start the year out for the first few months flat and then lower into a more permanent 6.25 range, which we flirted with in 2024, but never quite got there or stayed there. Now rates could take a sharper downturn to the 6 mark or even 5.5 mark, but we'd have to start that decline very early spring so they don't come crashing down and wreaking havoc on the markets, ramping back up inflation and overheating the economy. The third scenario is we could lose our grip on inflation completely, see egg prices in December. Oh my gosh, they're spiking again. How many bird flus can there really be? Here's what's actually not a wild card. Part of President Trump's platform he ran on was lowering interest rates down to the 3% range or even into the 2s. The Biden administration let Jerome Powell, the Fed chair, kind of run rates however he saw fit with very little commentary. However, presidents cannot control interest rates, only the Fed chair can. And the Fed chair can choose to step down, but cannot be removed until their appointment is up. And that's not until May of 2026. So let's look at what the experts have to say. The most notable are Goldman Sachs predicting a 6.1% interest rate on the low end, and Fannie Mae and the Mortgage Bankers Association coming in hot at 6.4%. Scope out Housing Wire in the middle, giving a range of 5.5 to 7.25%. That's like saying tomorrow water's gonna be wet. That is such a cop-out, such a cop-out. Okay, I'm putting my prediction that before the end of 2025, we're gonna see rates come in at 6 flat, possibly a 5.875%, but I'm gonna hang my hat on that small eighth of a point spread. Bottom line, if you're waiting for a 5% rate instead of today's 6.5 or 6.75 to buy, don't. That payment we can bring down once President Trump replaces Powell with somebody who's going to drop rates like a rock way over in May 2026. But that said, home prices will spike 10 to 15% when rates do fall into the low 5s and into the 4s. No one can bring you back that buy price. No one can bring it back down once rates come down. It's why we saw home values skyrocket in 2020 and 2021. Lower rates meant more buying power because buyers could buy more home at a lower payment. They did exactly that. So we're gonna see that happen again in mid-2026. For my FHA, VA, and lower than 10% down payment buyers out there, that heavy down payment or all cash competition has largely subsided, but it's gonna come rushing back to the market too. Remember, for every 1 percentage point the interest rates drop, the number of buyers in the market looking to buy a home jumps 25%. So those multiple offers, which are still a thing, but largely gone, are gonna be coming back middle of 26. HELOCs and REFIs. And HELOC stands for Home Equity Line of Credit. So while we're on rates, let's talk HELOCs and REFIs, and credit card debt for that matter, because all three of these play together right now. Then my take and advice at the end on what to do about it. So we ended 2023 flat with refinances, at the number of them being down just 6.5%, and the number of home equity lines of credit went down 4% year over year, which makes perfect sense because interest rates were wildly high, and if you have a 4% rate, why would you refi into a 6.5% rate? It makes no sense. However, that's going to change in 2025 for a couple of reasons. First, credit card debt, which crossed the trillion number for the first time ever with a T. We ended 2024 at $1.17 trillion in American credit card debt. That said, 50% of Americans have no credit card debt, or they pay their credit cards off in full every month, which means the other 50% that do have credit card debt are shouldering an average of $17,742 per person. Scope out credit card interest rates. With the Fed moving rates up so rapidly, they've spiked as well, going from 16% roughly to almost 22% at the end of 2024. The payment on that credit card debt is now 50% higher than it was just 2 years ago. So if you have it, you know, you've seen those payments go up. Further, let's look at rates. Hovering about 6.5% right now, maybe a little higher, going to a 6% is going to push people to refi. There are over 1.9 million home loans above 7% right now, about 8% of all home loans total, and 15% of all home loans are above 6%. Bottom line, Both home equity lines of credit and refinances will be up 10 and 30% respectively in 2025. That said, for most people, that refinance is not the right move for them. So let's set some parameters when we're looking at this. When rates hit 6%, do not automatically refi. Bookmark this video and come back to this part of it. If your loan is above 7%, do refi. Over a point move down is 100% worth it, 100% worth it. If it's between 6 and 7%, do not refi. The juice is not worth the squeeze. Squeezing out that extra quarter point or that extra half a point, not worth it. Wait until 2026 when rates drop another full point. And people ask me this all the time, why wait? The average refi costs about 2% of a loan amount, or for the average American, about $4,000. Now, you're not saving enough monthly to make up that difference on a half point or a quarter point saving, but a loan officer is going to try to push you that way because they pay out 8 times more income to a loan officer than a home equity line of credit. If you really want to pay down that credit card, if you want to refi your house, tap into your home equity and pay down that 22% credit card debt, don't refi, though you'll be called and pushed to do it that way. Do get a home equity line of credit. Why? You're going to have a 6 or 6.5% rate on only that very new small balance of 10 or 15 or 20K on that loan. Number 2, instead of costing $3,000, $4,000, $5,000, they only cost $400 to $800 to set up with most banks. Number 3, you only get charged on what you use. So if you take out a home equity line at $20,000, and you take $5,000 out to use, the other $15,000 that you're not using, you're not being charged interest on. And that 6.5% you're paying on a home equity line of credit is way better than the 22% on the credit card. Only about 9% of Americans will it make sense to refi in 2025. But 100% of loan officers will tell the other 91% that it makes sense. Last thought on this one. If you have a question on which scenario is best for you anywhere in the country, not just in Metro Detroit, call me, shoot me a text, shoot me an email. Let's chat about the scenario. I'd be more than happy to give you my honest, extremely honest opinion. Also, if you've got PMI on your mortgage and you're going to refi to get rid of it, don't, unless it's the same interest rate or a lower interest rate. Mortgage companies have to drop it once the loan to value hits 78%. Not 78% of your loan value versus the original loan value to market value. Most people don't know that. And when homes go up 5%, well, you just gained 5% more equity, so you're a lot closer to or even past that 78%. Call me and I could take a look and walk you through it. I don't make any money on loans, by the way, but I do on referrals. So if I give you great advice, you might refer me to somebody looking to buy a home one day. It's a win-win. And before we get to new construction, we are the top real estate team in Metro Detroit, and we'd be honored to get the call to help you and your family find your next home. Even if you're 6 months or 12 months out, book a call on our calendar at a time that works best for you to start planning your move. The sooner we start, the less stress there is, and the better chance we can find a better home for you. All right, next up, I've got new construction. Okay, this is going to be a brief one actually. So new construction stalled a bit in 2023, mainly because these homes are larger and in the nice to have but not necessarily need to have category for most buyers. So we ended 2024 slightly, very slightly down in new housing starts here in Michigan. In Michigan, there were 19,703 new homes built in 2024, and there were 19,552 new homes built in 2023. Nationally, we saw a very modest 2% increase in new homes being built, essentially flatline, rising from 1.289 million homes to 1.311 million homes. That's it, guys. However, if you're driving through areas like South Lyon or Commerce or Milford or Flat Rock or Oakland Township or Shelby Township, Utica, Ann Arbor, and of course downtown Detroit, it may not feel that way. So go drive through South Lyon and it looks like all there is are new homes going in, mainly at Irwin's or Blake's, but it will always be Irwin's to me. And hats off to Blake's for making that apple orchard a better, funner place since taking over. If you haven't been, get out there to South Lyon and scope it out. Anyway, new construction homes are typically 50 to 80% above an area's average price, and they sell at a much higher price per square foot, putting them out of reach for most buyers, simply put. To put that in perspective, nationally, if you have a $480,000 average sales price, that means a new construction will come in that area around $720,000 to $850,000, which is pretty typical for a new build price. Also, we don't typically see new construction in areas that are below the median home value here in Metro Detroit. So here's an example. In Michigan, the average sales price, the average home value is about $300,000. Cities where the majority of these homes fall below that number rarely see new construction on any level. It's typically non-existent. I do see this changing a bit in 2025, maybe a skosh, and more so in 2026. We need more affordable homes in America. Not just new ones, just more affordable homes. Not these behemoths, these giants that so few can afford. We've got a first and second time home buyer problem, not a luxury problem. So 2025, we're going to see new home construction jump 10 to 15%, just the number of sales here in Southeast Michigan and nationally in 2025, mainly because the boomers are still not selling. There just aren't enough homes, but almost all the builders that were wiped out from the 2008-2009 crash have been replaced or they got back into business. Labor shortages, while still there, have shored up and material costs have come back into line. My caveat on that is going to be the tariffs. If Trump does in fact put in his planned tariffs on Canada, Mexico, and China in early 2025, we will actually be flatline or even down 5% as far as new construction goes, because of the added 10 to 15% cost to build a home are going to cause a lot of buyers to either wait or go back and buy a resale home. We're finally seeing some more affordable homes come up in Metro Detroit, specifically Detroit, but I don't think 2025 is the year that new construction gets scaled back on size and scope. I think 2026 might be, but overall, if the number of new construction homes built in 2025 grows by 140,000 over 2024's number, it will move us in the right direction. But even with that, we're still actually short 8 million homes for our current need in America. The stock market. Okay. 2022 definitely sucked with recession fears grinding down the market, inflation out of control, and of course the interest rates that just climbed 11 times, right? 2023 was pretty all right, and we gained back what we lost in 2022, and that was cool. Now 2024, now that was fire. I mean, even Tesla's fully recovered from its November 2021 peak where it was $407 a share, dropped 50%. At the time of this recording right now, it's $409 per share. But not everyone in 2024 won. Boeing got crushed, ending the year down 29%. I don't think anybody out there was surprised with all the troubles that they've been going through. Intel was down 58%, battered from its chip war with Nvidia. Dollar Tree was down 48% from the start of the year, but overall, the market was up roughly 24% in 2024, and most places in the market were safe. The Magnificent Seven stocks, which apparently has replaced and expanded on the FANGM stocks, or FAAMG stocks, did very well. Apple was up 23%, Microsoft was up 12%, Amazon was up 36%, Google up 21%, Tesla up 38%, and of course you've got Nvidia up 179% in 2024, and Meta, or Facebook, or whatever you want to call it, up 62%. Our American tech sector firmed back up a lot in 2024. But what's going to happen in 2025? Should I buy? Should I hold? Should I sell? And then put cash into like a high interest rate savings account? Well, let's take a look at what the experts are saying. BCA Research is again the most bearish on the market, with the S&P 500 price target of 6,200 by the end of the year. JP Morgan is still a little bearish, but a little higher. Their prediction is the S&P is going to end around 6,500. Morgan Stanley is matching that at 6,500, and Goldman Sachs is coming in at, you guessed it, 6,500. I mean, I think these guys all just like get on a phone together and say, hey, what's your prediction? What's your prediction? What are you going to do? Let's do this. Let's put these out. Look, this is what we're doing. Of course they talk. Of course they don't. I mean, it'd be unreasonable to think that they don't. Okay, Bank of America, always more bullish than most, is coming in at, I'm not even kidding, 6,666. And Michael Perna, me, is coming in with a spike up to 7,200. I am definitely the most bullish. I'm coming in way high, way high. And I was the only one that did that in 2023 and nailed it. And in 2024, I was the highest prediction by 400, and the S&P still outperformed my prediction by 200 points. Bottom line, towards the end of 2023, I implored my family, my friends, and my clients, and pretty much everyone I knew to stop selling their stocks and just hold. Hold the stocks, hold the mutuals, hold the ETFs, all of them, leading to today's giveaway. Morgan Housel, in his book, The Psychology of Money, said, you simply cannot time the bottom or the top of the market. The first 10 people that like this video, subscribe to the channel, and leave a comment below telling me what videos you'd like me to cover in the future, could be anything finance or any place in or around Metro Detroit, I'm gonna send you a copy of that book or another great book that I think is really good, Unreasonable Hospitality. Now, this is a great one my leadership team is reading right now in an effort to top grade our service to you, the people in Metro Detroit, when we help you buy and sell homes. Our reviews speak for themselves. We have over 3,000 5-stars on Google and Zillow, but can we get better? I say yes. Will we get better? Yes, definitely. Do those couple of things. I'll get you one of these books out your choice. Next up, I've got inflation. And inflation has been the four-letter word of the economy for the last couple of years, and we've all seen the memes or memes or whatever you call them of what groceries cost the McAllisters and Home Alone in the 90s and what that same amount of food actually costs now. We're finally seeing some relief at the pump with gas prices ending the year at $3.03 per gallon on average versus $3.52 per gallon, which it was earlier in the year. But rents went up just in the last inflation report as well. Also in 2024, we finally hit numbers that started with a 2 and not a 3 for inflation, and definitely not a 9 that we saw from just 18 months ago. God, that was terrible. So terrible. But we're not all the way there yet. 2.7% is where we landed at the end of the year for 2 months in a row. I don't think with the holiday season and the buying overdrive, we're gonna see that number go below 2.5 on the next 1, 2, or maybe even 3 inflation reports. Probably not until March. Many economists believe that we're actually gonna go below 2% in 2025, but I honestly think that's just a pipe dream. Just simply a pipe dream. I really think we're going to see mid and low 2s in 2025. Not the flat 2% the Fed wants. They're just going to have to swallow it and deal with it. But I think we're going to see a 2.5 or possibly a real outside chance 2.4 in March, and that will trigger the first of 2 rate drops in either April or June. So we've broken the back of inflation, but it is definitely not dead yet. We've seen a major pullback, but we've also seen record sales for Christmas. Spending was up 7.9% year over year, as well as a strong job market through winter. It's going to be mid 2s, not low 2s, between the end of the year and mid 2026. And here's why the Fed will be okay with it: wage growth. In 2024, we saw a 4.6% wage growth per the Department of Labor. As long as that number continues to outpace inflation, I think the Fed will not take a wrecking ball to the economy, aka raise interest rates, even if inflation ticks up slightly. And that said, wage growth finally shot past inflation. Scope this chart out. We've been ahead of inflation now for 15 months in a row, but by all forecasts, this is also not sustainable. I believe wage growth is going to cool to a more normal 3.5 to 3.8% in 2025. Lower, but thankfully still above inflation. And there are no economists predicting wage growth to expand above the 5% mark, save one thing. I think we're going to have a very short-term pop here in wage growth in the first quarter of 2024, followed by a pop in inflation in that same quarter. Because on January 1st, 9.2 million Americans will have their minimum wages raised, totaling $5.7 billion in wage growth. So why am I calling $5.7 billion a small pop? In automotive, after the strikes in 2024, wages to American automotive workers increased by $4.8 billion, but the month they took effect, wage growth only went up 0.2%. Now, as the job market's been slowing because of inflation and rates and the effect it has on companies tightening the belt, in 2025, unless the job market changes drastically, the job you have is probably the best job available in most sectors. The 2 sectors where we're seeing major layoffs right now are tech and cybersecurity, both the fastest expanded parts of the economy over the last 4 years, and now the fastest to contract in right size. I personally know a lot of people affected by that contraction. If you're in those fields, it would not hurt to brush up on your industry contacts, brush up on your LinkedIn, no matter how secure you think your job is. Next up, crypto. So Bitcoin shot up to 93,000 from its start in 2024 of just 42,000. But the rest of the crypto market, with a few outliers being the exception, not the rule, is still in massive turmoil. So if Bitcoin is the gold standard, Ethereum is the silver standard in crypto, and while it rode the Bitcoin coattails, it didn't ride it to over double like Bitcoin did. It's up just a little under 50%. Now, my dad always says, invest in what you know. And I'm a geek and I like tech, so I like American tech companies. I also like investing in real estate. I don't like crypto. I said what I said. The few bucks I put into Bitcoin did amazingly well, and I'm going to hold on to it through 2025. Now, USA Today believes we're going to have a very bullish crypto year. I just won't be there to see it. I'm just personally not a fan. It's a personal opinion. If you love it, good for you, but I always advise people invest in what you know because you know more about that industry than most other people do. Let's move on to the luxury home market. So the numbers are in. In 2022, we saw 1,590 luxury home sales here in Metro Detroit. In 2023, that number went down a little bit to 1,497, a little under 10% less. Mainly this was due to less homes to buy, not for a lack of demand or recession fears, which were real in 2023. In 2023, we saw builders pull back hard from the luxury market, and for someone someone to move from a $700,000 house to a $1.5 million house in 2023, it was a like to have and not a need to have. Now in 2024, luxury home sales in Metro Detroit regained its footing, shooting all the way up to a record 1,973 home sales. Now this was caused by more homes being available, builders jumping back into the luxury market, and confidence in the economy overall. I always look at luxury home sales as an indicator or taking the temperature of the economy. Also, this was not due to interest rate decreases. More than any other types of buyers, luxury home buyers care less. They care the least about interest rates, right? Because they have all the money. Go figure. Looking forward to 2025, my prediction is we're going to see just north of 2,300 luxury home sales. This is going to be because of three reasons. First, as home values go up, more and more homes will cross into that luxury category. Second, more homes will be available to buy because the luxury builders are back and building again. And third, this home seller, more than any other type of boomer home seller, will shake loose and sell because of the ongoing maintenance cost and taxes on maintaining an estate-sized home. Now, if you're a home buyer in this category, I typically like to meet and consult a full year in advance of a purchase. I'm not saying it will take a year, but there are a lot of luxury properties that have deferred maintenance and inspection issues, and it could take a long time for a great one to come to market. Much longer than, say, the $300,000 and $700,000 range, where properties flitter through the market each and every day. Also, with such a long runway, if there is a multiple offer situation, you won't feel pressured like you need to buy that specific one because you're short on time. Now, if you're a home seller, do the kitchen, do the bathrooms, do all the cosmetics needed. Not the things that feel like they add value only because they cost money, like mechanicals and roofs and windows. Like the old adage says, if it ain't broke, don't fix it, just leave it alone. If you've got life left on it, leave it alone. If you can see it, improve it. If it's hidden like a furnace down in the basement, don't touch it. Second, hire an interior designer, or frankly, just hire us. We provide one at no cost to our sellers. The value of the interior decorator or interior designer is they're going to help guide you on what improvements are going to take you to the top sales price possible, period. Okay, rent. Now we've seen some severe rent spikes in the last few years. Then all of a sudden, rents came down 5% at the end of 2023. And in 2024, my prediction was rents would literally flatline and be straight up even. And that's what happened. Up a little under 1% in some areas of Metro Detroit, down a little under 1% in some areas of Metro Detroit. So here's my prediction. Rents in Metro Detroit will be straight up even in 2025. Not a lot of movement in the sector, not a lot of excitement. People will be moving into homes and out of apartments as rates come down, but the truth remains that about a third of Americans will always be renters and always are renters. As investors buy more homes and apartment complexes keep getting built, rents will just be what they are. Not up, not down. We're going to end the year where we started. All right, before we get to the property tax explanation, as promised, comment below on what you see happening in 2025. Do you agree with my predictions? Am I off the wall nuts? I'd love to hear from you. One last time, don't forget to subscribe. Okay, so here's why a lot of boomers are staying in their homes here in Michigan and nationally, and what all buyers should ask from their real estate agents so they don't get smacked in the face with a tax bill that doubles. A home has two tax numbers assigned to it. There's the taxable value and the state equalized value. Each get adjusted each year. This number here, the state equalized value, is about half of what the city believes a home value to be, what the home is worth. The lower number here is what the actual taxes are based off of. Now, how we got here. In Michigan in 1994, Proposal A was passed that would limit the increase in property taxes to either 5% or the inflation rate, whichever one was lower. So even that 9% year in 2023, where the inflation rate was just way up there, a homeowner's taxes still only went up a max of 5%. Notice these two numbers keep getting further and further apart each year. They just passed something similar in California, actually. If you're in California, go call a local real estate agent to talk to them about it. But why do states do this? To promote longer-term home ownership and less transient communities. Communities with less turnover are more stable. Now check this out. When the next person buys this home, the taxable value will uncap and rise to the state equalized value. And then the process will start over for that next homeowner. So the taxes on this home will literally go up about 50% with the resetting of the taxable value. So they'll be moving from the $8,792 in the 2024 year, doesn't have the winter tax in there yet, so I'm using 23, to a little closer to $13,188. Now that's very rough back of the napkin math, but is fairly accurate as well. Now if this owner sells, wherever they buy, their taxes will also uncap and climb. For the next person who buys this specific home, that's going to be a $4,400 per year increase in taxes, or $350 per month. Their payment's going to move up once it catches up. So if you're buying a home, we actually provide this report plus the estimate of what the taxes will be for the next person to all of our buyers before they write an offer. So they're actually writing an offer eyes wide open. They've got all the numbers. And there's no surprise. There's no letter in the mail that they get 6 months later saying, hey, guess what, guys? Your payment just went up $200, $400, $800, $1,000 a month. And I've seen all those numbers happen before. If you're not working with us, ask your agent for a copy of this report and for the link to the state estimator site. I'm gonna actually put that link down in the description section so that you have it right there. Also, if there are topics you think I should cover or do an additional video on, please comment. I'd love the feedback, and I could really use some great ideas for 2025. I want to continue to make this channel your go-to resource for Metro Detroit and Metro Detroit real estate. And guys, that's a wrap. That was a lot of info that I packed into one video. I probably should have split it up into a couple of videos, but thank you for riding along with me through where the economy is going in 2025. Cheers to a new year, stay safe, and I'll see you on the next video.